And I hope all of y'all have had a good week so far. And today we are going to be talking about loans. So this is going to be the last form of financial aid that we've looked at in all these workshops. And I know oftentimes that we have cautioned you about loans, and really we don't want y'all to take out loans, but they truly can be a good investment. So what we want to do is we really want you to be informed about basically what all entails loans. So first off, what we're going to talk about are what are loans. So the definition of a loan is an amount of money that is borrowed, often from a bank, and has to be paid back, usually together with an extra amount of money they have to pay as a charge for borrowing. To put that in simple terms, it's if you borrow money, so you borrow money to spend it on something. In this case, what we're going to be talking about is student loans. Basically, you're going to have to pay that back, plus you're going to have to pay money on top of that as a fee for borrowing the money. So again, we're primarily talking about student loans today. And student loans, those things go towards things like tuition, fees, books, room and board, and other supplies that you're going to need throughout your college career. Next, we're going to talk about some loan lingo. There's a lot of terms that are associated with loans, and sometimes specifically only associated with loans. So let's get started. So principal. Principal is the amount of money that someone borrows. So if you take out a loan for, say, $10,000, the amount, that $10,000 is what's considered the principal. So that's basically the amount that you take out and you're able to spend on things. So the interest, that is the money that a borrower owes the lender on top of the principal. So that's the fee that goes on top of the principal. Usually this is applied with something that's called APR, or annual percentage rate. And those numbers can vary with student loans. As you're going to see, it usually ranges around 4 to 5% for federal loans. Repayment period. So this is the time period in which a borrower has to pay the loan back. The most common ones for federal student loans, the one that most commonly gets used is like a 10-year pay period, but it can go all the way up to payments that span across 25 years. Repayment plans. While we won't go into this today, when it comes to federal loans, there are a lot of different types of repayment plans. They have some where it's basically just on the balance and you'll pay the exact same amount throughout the 10-year period. There's some where you pay very little at the beginning but a lot towards the end, and some of them are just completely associated with your salary. So if you get a job where you're not making very much, you won't pay a whole lot, but if you end up getting a job that pays more, then you'll have to pay more. It all depends on what your income is. Deferment period. So the deferment period is a time during which a borrower does not have to pay interest or repay the principal on a loan. So when it comes to student loans, generally with all student loans, you don't have to make a payment until after you graduate. As you see, there's actually a 6-month period after that where you also don't have to make a payment. So basically they're saying, hey, we know you just graduated. We'll give you time to get a job, and then hopefully within 6 months you get a job and you can actually start making payments towards your loan. And the last term on here, it's a little in the weeds. It's called forbearance, and it allows a borrower to temporarily stop making loan payments. Now, forbearance can occur, basically you can sort of apply for forbearance and the lender can either give it to you or not, but it's usually whenever you have like financial difficulties or medical expenses or change in employment. Maybe a business got shut down and you no longer have that job, and for a short period of time you say, hey, I won't be able to make these payments, and they'll work with you and they won't make you have payments over that time. And in all actuality, I have student loans, and as of right now, my loans are in forbearance, basically due to COVID-19. They also dropped our interest rates down to 0. So from now, I believe it's till either August or September of this year. Basically, we don't have to make any payments during that time, and that's with federal student loans. So go into this. Before I go any further, I want to give you a little warning about student loans. Unlike other types of loans, student loans have to be repaid no matter what. So with other types of loans like mortgages, car loans, if you have credit card bills, let's say for instance, you get out of college, you get an awesome job where you're making $100,000 and you basically, you get a nice new car, you take out a mortgage, and that business goes under and you no longer have that income. Well, all of a sudden you're not able to make these payments. Well, you can file for something that's called bankruptcy. And basically that'll wipe out all those debts that you owe, except for student loans. Regardless of everything else, you were going to have to pay back student loans. So just be wary of that. Okay, so the first two types of loans we're going to talk about are specifically federal student loans, and these are unsubsidized and subsidized. So they're automatically offered whenever you apply for FAFSA, and it's true for both. Same thing, so payments are deferred until you graduate. Also has the 6-month grace period, which we talked about earlier, where you basically don't have to make any payments during that time. But the big, huge key difference in this is that the loan accrues or gathers interest instantaneously with an unsubsidized loan. And a subsidized loan, basically it doesn't accrue interest until after the grace period. And this is a big difference. It's a big difference. Well, there's going to be an example later and I'll show you why. But if you're going to get a loan, you're going to want to get a subsidized loan. And just word of caution, just because you're offered a loan doesn't mean you have to accept it. And it doesn't mean that you have to accept all of it. You can accept parts of it, you can accept none of it. But just because you're offered it doesn't mean like, oh, okay, I guess I'll go ahead and take it. Or basically only take out loans that you absolutely need, which again, we'll touch on a little bit later. Another type of federal loan is called a Direct Plus loan. So these are offered to graduate and professional students, but they're also offered to parents of undergraduate students. So with this, the loan that the borrower receives is in the amount that's still owed. So say if you have to pay $20,000 for your college and you took out loans and all of it covered $15,000 of it, well, the parent could then take out a $5,000 loan to cover the rest of that, what you owe. But with this, there is no deferment period. So as soon as that loan is dispersed, the borrower is going to have to start making payments immediately. And also, these are based on a credit score. So if the person that's borrowing it doesn't have a good credit score, either the loan that they get is going to have a very high interest rate, or they won't be able to get it at all. And again, this is all dependent on the parent. So maybe the parent just honestly won't want to take out the loan. But anyway, I just wanted to let you know that Direct Plus loans exist. So private student loans. So private student loans are offered by bank or other financial institutions like credit unions. They're generally used as a supplement to, not a replacement of, federal student loans. So if you take out loans, you want to take the federal student loans out first and then go to private student loans if you're needing more than what the federal student loans are going to offer you. And again, these are based on the credit score of the borrower. So if you're taking out in your name solely, you're probably going to have little to no credit by the time you graduate from high school and go to college. So the credit rate on these are probably going to be pretty high for you. As the last thing says, probably be higher. The caveat to this is you can have a parent with a very good credit score who can co-sign with you, but I won't really go into that because it's a little too in the weeds right now. Okay, so this is going to be an example of a subsidized versus unsubsidized. So the example is a student takes out a loan at the beginning of their freshman year for $10,000 with 5% interest. When they have to start making payments after their 4 years, 45-month college career, plus the 6-month grace period, how much will the loan balance be if the loan was subsidized? Well, if you remember what we said earlier, subsidized loans accrue no interest during that entire time until you have to start making payments. So the answer is $10,000. So you just now have to start making payments to pay off that $10,000. However, what if the loan was unsubsidized? So you see that little compound interest formula down there at the bottom. Basically, if you plug these numbers in, you'll see that the unsubsidized loan amount is $12,367. That means you'd have to pay, basically when you start making payments, you're gonna have to pay off $2,367 more dollars than if you would have taken out a subsidized loans. This is why if you need to take out a loan and maybe it's just a little bit, you want to go with the subsidized loan if you can. So how much will you have to pay back and how long will it take? So this is just sort of just an average example that's going to show you. So the average student loan debt for a recent graduate with a bachelor's degree is $29,000, and the average student loan interest rate for undergraduates is 4.53%. So again, so if you want to pay this off in 10 years, so you go with the 10-year repayment plan, your monthly payment is going to be $305 a month. And the total cost that you're going to have to repay back on that loan is $36,555. Again, that's $7,555 more on top of basically your principal, that $29,000. So that $7,555 is the fee that you have to pay on top of what you borrow. And that $305 a month, now remember, that's every single month for 10 years. So if you can, basically you want to do whatever you can to not take out loans, because think of that $305 every single month. If you instead graduate with absolutely no debt, with that $305 a month, you can probably take a trip to Disney World every single year for 10 years and still be spending the same amount of money. So, and before I go any further, I'm going to go ahead and tell you my secret word, and it's sandwich. That's what I'm eating tonight, a turkey sandwich. But the secret word is just sandwich. So debt management. So these are ways to reduce your financial burden. Okay, so the first one is Best Fit College. If you remember from the Best Fit College workshop, considering the cost of where you go to school should be your top priority. So you want to make sure that the school that you go to is the most affordable option to you. So if you're wanting to get a nursing degree and you're looking at, say, between TCU and UTA, and maybe you don't have a bunch of scholarships, well, the loans that you might have to take out for TCU might be somewhere like $100,000 compared to maybe $10,000 at UTA. So basically, your Best Fit College should, like, that's basically your top priority should be knowing the cost of where you're going to be going to school. And also, if you remember from the college roadmaps workshop, the path that you take also greatly impacts the amount of debt you leave with college. So say again, you want to get a nursing degree from UTA, but instead of going to UTA all 4 years, you instead go to a community college for 2 years and then transfer in. And say if you went there for 4 years, maybe you would have to take out a loan of $5,000 every year if you went just straight to UTA. And whenever you went to a community college, you didn't have to take out any loans. And say you only had to take out loans for 2 years whenever you went to UTA. So in one scenario, you would leave school with $20,000 worth of debt, and the other one you would leave with $10,000 worth of debt. There's just many different options and choices to make during all of this. But just try to, think of like the best roadmap and, try to figure out what will work best for you. Another thing is to only take out what you need. Your school is going to offer you the max amount of loans you can take out for that given semester. But you can always request to take a lower amount. And my advice to you would be definitely take out as little as you possibly can. You might have to take out some money, but don't take out more than what you need. Only take out what you need. The third is work. Work, work, work. While you're in college, your primary focus should be on your studies, but with a job, you can save money so you can reduce the amount of loan you need next semester, especially like summer jobs where you can maybe work longer hours. Again, you can maybe lessen the amount that you'll have to take out in loan amount in the following semester, or going number 4, you can start paying your loans while you're in school. Even though you don't have to pay your student loans while you're in school, you can start paying your loans off while you're in school. And it's to be very beneficial in either case, whether it's unsubsidized or subsidized. But if it is subsidized, it's not accruing any interest. So basically getting that thing as low as possible before it starts accruing interest can actually save you a lot of money. Is getting a student loan a smart investment? Well, the answer to that is, it depends. There's so many variables to consider in this, and some of the large ones I took out was like loan amount. Like, again, if you wanted to go to, again, a nursing degree at UTA, maybe you'll have to take out $10,000, as opposed to if you went to TCU, maybe $100,000. Maybe the $100,000 loan might be a little too much, although the other one might not be too much. But also what job you get. So you want to know sort of what like the beginning salary of your job will be, and what like the medium range of basically the salaries of that job, so you can know if you're going to be making enough money to be able to pay back that loan. And the last thing is sort of smaller, but job outlook. So some jobs are in more high demand than other jobs. So maybe the thing that you're getting a degree in, maybe it's a hard career to get a job in. So maybe there will be periods of time where you're actually not making any money, even though in general they do make more money. But again, there's so many variables to consider, and it's just depends on so many things. So in conclusion, I know all this can look really scary, but sometimes taking out loans isn't the worst thing you can do. Just be cautious of loans, but don't avoid them if you are able to. Basically, if taking out a loan is the only thing preventing you from furthering your education, it might be something that you want to do. And with that, I hope you were able to learn a little bit, and I'm now open for questions.